go.
Well, good afternoon. I'm Linda Gerchick Real Estate, and we have Ann Cornelius, who is our referral partner, CPA, and she's here to talk about cost segregation, chattel, which is something that a lot of people, investors in particular, need to pay attention to. Would you agree?
That is correct, absolutely.
And Ann's been working with us for several years. She comes to us from another referral partner, who is our attorney that we refer to. So that being said, we're all one tight-knit group. And Ann's going to take it away and speak about chattel. Thank you, Ann.
All right, thank you, Linda. Okay, well, we'll go ahead and get started. And as Linda mentioned, we'll talk about chattel and what that means and how that works and how you can save taxes. Essentially, we're talking about turbocharging your tax savings. Okay, and let's go to the next slide. So, why is real estate so tax friendly? That's the question that we're going to answer here.
Okay.
It's because of depreciation. So, all right, so the biggest tax break for real estate investors would be depreciation. What that is, it's a deduction for the cost of the building and its contents, which is spread over the period that's designated by the IRS. And the period for residential real property is 27 and a half years. So in other words, you're taking what you paid for the property plus some adjustments for cost of making that purchase, plus improvements to the property, etc. And you're taking that and depreciating it and expensing it, in other words, over a period of 27 and a half years. And there's a longer life for commercial property, and when I use the term commercial, I'm not talking about it in the same terms as you are in the real estate world. Commercial, to me, in the tax world, means it's used for business purposes. Commercial, I know in the real estate world, is talking about multiple units. What is it, 4 or more than 4?
So Ann, if we could be clear on the residential.
Yeah.
Anyone that a tenant lives in it
Yes.
would be, even if it's 200 units, right?
That is correct. When we use the term residential, it means that people live in it, not work in it, but live in it. So apartment complexes are residential. No matter what the size, it's still residential. So we'll be clear on that. And that's what primarily we're talking about here. And again, as I said, it's based on the purchase price of the property. You do need to back out what is deemed to be a land value, because land doesn't depreciate. There's nothing there to depreciate. It's the building, it's the structure that depreciates. So we have to back out a value for land. Oftentimes that figure is 80–85% building and the rest being land. So let's take a look at an example here. So let's say that you have positive cash flow from this rental property. After you've collected rent, you've paid out expenses for property taxes, for insurance, repairs and maintenance, whatever else you've got. After all is said and done, you still have $5,000 in the bank. But then, on top of that, you get to deduct depreciation. So in an example, typically the depreciation, particularly in earlier years, you're going to see where you have more expenses, and then you add on depreciation. By the time you throw in depreciation, you now have a tax loss. So in the example here, we've taken $8,000 in depreciation, and now we have a $3,000 tax loss. But you still have $5,000 in the bank. You had a tax loss, so you didn't pay any income tax. Okay? So, let's say now that you bought the property and you spent $4,000 to make it simple, $400,000 to make that simple. And then let's just say that the land value was deemed to be $60,000. So you're going to subtract that land value out, and then now you come up with a depreciable amount of $340,000. That's the amount that you depreciated over 27 and a half years. So the first year depreciation, let's say $12,363 is going to be the depreciation on that based on a 27.5-year life. So that is going to be your deduction in our calculation here.
So Ann, here's a question. If
Yeah.
somebody buys a property and the previous owner has depreciated it, how does that affect the depreciation here?
Okay, so if you buy a property and it's not a new property, you know that the previous owner has depreciated it themselves. That does not matter. You are starting over. You're starting over with your cost and you're depreciating, because what you're doing, you know, even though it's deemed depreciation, what you're doing is you're taking your cost, your expense, but you can't expense it in the first year. So the IRS gives you a life and says you depreciate your original cost over this life, which we tell you is 27.5 years.
Thank you.
Okay? All right, so in a 40% tax bracket, what you're doing here is you're saving $4,945.
So the depreciation expense, whatever tax bracket you're on,
Depending on your bracket, 40% would be, you know, we're talking highest bracket. But looking at that bracket, that's your tax savings. And your bracket is all depending on, it depends on the rest of your income as well. It's the big picture. So you could be in other brackets. Okay, so now, here's where we start getting into chattel. This is how you can speed up the depreciation deduction. So this is a neat little trick, and it's perfectly acceptable to do this. The IRS acknowledges this. It's deemed to be what we call cost segregation, where what you do is you can segregate out certain elements of your property and deem it to be chattel instead of real property. Well, chattel is depreciated typically over a 5-year life, not a 27.5-year life. So you're basically going to be accelerating some expenses here. Chattel is something that is not permanently attached to the building. And we'll get into some examples. It's something that is not essential to making the building function. And we also can pull out things that are deemed to be land improvements. These are not chattel, they're just simply land improvements, and they're depreciated over a 15-year life. So here again, you can shorten the depreciation period substantially. You're cutting it by more than half. And those are things like landscaping, sidewalks, swimming pools, etc.
would that like a storage unit, covered parking, that type of
Things
stuff?
of that nature, typically some ramps and things, and yeah, we'll get into, I think I've got some examples in here. Let's take a look at what else we have. Okay, so here we have our examples. First of all, the obvious ones, we have some appliances. If you buy an apartment complex and it's got appliances inside, even a fourplex, even, you know, anything, it starts to become even more beneficial the more doors you have. So, for every stove, for every range hood, oven, garbage disposals, microwaves, dishwashers, refrigerators, you bought those with the purchase. They were included in your settlement, but they weren't segregated out. So you have to take some extra steps to do that, and we'll get into that too. But these items can all be depreciated over 5 years. These are chattel. And here we have improvements, certain types of improvements. Kitchen cabinets, in some cases, pantries and things like that. It's kind of a situation whether is it something necessary to have a kitchen, or is it something you could do without. You have to look at each case individually, but many times kitchen cabinets can be deemed to be chattel. Removable flooring, ornamental millwork, you know, let's say you've got some crown molding around the top. It doesn't need to be there for the building to function. It's extra, it increases the value. Those are things that can be separated out.
You have one quick question on removable flooring. Is that like carpeting?
Yeah.
Okay.
Yeah, carpeting is, and even when you add carpeting, it has a shorter life as opposed to a lot of other improvements. Carpeting is a separate kind of thing. Concrete work, you know, maybe trying to think of a good example, maybe some kind of just a decorative wall or something. That's a lot of times there's concrete for handicap accessible ramps and things like that. We get into that too. Covered parking, that Linda, you mentioned that. Driveways, where you pave a driveway. Carpet and pad, there's your example right there. Internet, when you put in extra jacks and things, maybe you're putting in for cabling, for internet and whatnot, those are extra. And even if they were already in there, you can segregate those out. Landscaping, we talked about that a little bit. Planting trees that, maybe some new trees and whatnot that are there. The swimming pool, countertops, like granite tops and stuff. Irrigation system, some of those can be pretty costly too. Security doors, like security screens and whatnot, those are expensive, those are extra. And the handicapped accessibility, and then the pantry, of course, we talked about that too. Okay, and also, you're not gonna run into this a lot, but something like a wine cellar kind of thing, those are, yeah, I want one. Well, I wanted one, my husband decided it should be a golf closet, so didn't get one. Furniture and fixtures. The obvious things like furniture. Ceiling fans, we don't think about ceiling fans. Really all you need to have a room functional is, you don't even really need light fixtures because you can plug a lamp in. But a basic light bulb hanging out of the ceiling, it really doesn't have any value. But there are some very nice ceiling fans out there, and chandeliers and things like that. That are extra, and you can remove those from the property. And if you've ever seen some of these foreclosures, you know that they take all that stuff. Yes. But built-in desks, that's another one. You'll sometimes find units that have some built-ins that they've converted a room to an office or whatever. And lighting fixtures, scones on the wall in the hall, anywhere. Those are add-on features.
Murphy beds.
And shelving, and what's that?
Murphy bed.
Yeah, no, that's a built-in really. Those are more built-ins. Yeah, Murphy beds, anything along those lines. Built-in wardrobes, smoke detectors. Those. Especially when you've got that whole apartment complex full of smoke detectors, it starts to add up. Security systems, sometimes they're already in, and you can keep those in mind too, because those are extra. Space heaters, window air conditioning, not your AC unit on the roof or in the attic, but window air conditioners, because those can be removed, and they don't have anything to do with the structure. Window treatments, blinds and drapes. Wood blinds, shutters, all of those are extra.
So something like sunscreens would be,
Yes.
okay,
Yeah, like you peel off your window, that too.
okay.
Okay, so what does all this mean to you? Cash, money. Money in your pocket because of the reduced taxes. And we typically will find 8 to 12% of the purchase price of the property in chattel. Okay, so that could be pretty considerable. Let's take a look at how that might work. So in our same example, purchase price $400,000. Let's just say the chattel that we've pulled out of that is 10%. So $40,000 of it is chattel. On the chattel, this is how the allocation of depreciation will work. 5-year depreciation is not equally spread out over 5 years. It's different percentages for different years. The first year is deemed to be half-year life. The second year is usually the larger amount, and then it kind of goes down from there. It's actually called a modified accelerated rate system of depreciation. So you get more in the beginning and less in the end. So these 2 years are, there's 2 years here that are the same, and then there's a 6th year because the first year you took basically a half a year of depreciation. So what you have here is 8,000 the first year, 12,800 the second year. You see the different figures over a 6-year period. The last is the smallest, but you get most of your depreciation up front. So let's kind of take a look and see how that works in the big picture. So the depreciation, as we talked about before, the depreciation without chattel, we already mentioned, was about $12,363. Now, if you were to take the, if you do the math and subtract out the chattel portion and add that back in separately, you actually get $18,909 in depreciation instead of $12,363. So you have an additional deduction now of $65.46 because you've done that. And that's in 1 year. That's in year 1, actually. Okay. Now, we now look at the tax savings at the 40% bracket. So without the chattel, you already have a tax savings of $49.45, as we discussed. With the chattel in the 40% bracket, you now have a tax savings of $75.64, which is an additional savings of $26.19. Now, that was looking at a scenario of a property that's $400,000. So if you're buying a larger apartment complex and you're spending more, obviously all of these figures are going to increase exponentially.
And what if I had a building, okay, and I bought it a couple of years ago, but I've just learned about chattel? Can we go in, have the appraisal done, and can we start then using the
Well, you know, the IRS typically says that whatever method that you start with is what you should be, that you should remain with. So, what you want to do is do this in the beginning. When I say beginning, I mean before you file your first tax return. So, you know, if you bought the property in January, you've got a good year to make sure that you get all of your ducks in a row to take care of this. So, how do you do it? Well, if it's a new build, the builder usually already has this information. They know the cost and the value of all the different components they put in there. And if you say, you know, I would like an itemization of my appliances, of my fixtures, my this, my that, they can do that for you. The second thing is you can do it yourself. What that would entail is you would need to keep documentation as to where you arrived at your figures. If you bought an existing apartment complex and it has all these different appliances in there and they're all different ages and types, and how are you going to determine the value of each one? And are they all the same? Are they all different? Refrigerators of different sizes and whatnot. How do you figure all of that out? If you're going to do it yourself, you're going to want to keep good documentation of how you research, print out, I don't know, eBay, what would it cost me to buy these items? You can do it. I would say it's probably pretty time consuming. Chattel appraisal is probably the easiest way to go about doing that. There are people that do that for a living. That's all they do. Cost segregation people, they usually use the term cost segregation.
And should we be clear that the chattel appraisal has nothing to do with the value of the building?
Oh yeah, absolutely. It has nothing to do with the value of the building. It's not some percentage. You don't arrive at this by...
But it doesn't take the place of an appraisal but for lending purposes.
Correct. Oh yeah, no, the purpose of this is a cost segregation study. It's a cost segregation study. People do this completely separately from a real estate appraisal or anything like that. These are people who specialize in cost segregation studies, and they will provide you with a report basically saying this is the value of each of these individual assets. And you use that information then to go back to your CPA and say, here's what I've got. Let's, you know, segregate these out and adjust my depreciation. But again, you want to do it in year one. Before your tax return is filed is when you want to make sure you've handled all this. Okay? All right, so that pretty much explains that. Pretty cut and dry, simple. And this is all of my contact information if you need it. Email address, phone, etc. And I'm located in the Old Town Scottsdale area.
And you practice in all 50 states, is that correct?
Oh yeah, oh absolutely. I do tax returns. If you've got property in California or anywhere else, California's not my favorite place just because their taxes are high, and I just hate to see what they do to people over in California. But we have, you know, we do tax returns in every state that has an income tax. And they don't all, but most of them do.
And in addition, you also work with a lot of our foreign investors to do their American taxes, correct?
I do. Many of a large percentage of my clients are foreign investors, primarily Canadian, but some others, that own real estate in Arizona and in other states. So we do quite a bit of that.
Good. And Ann, thank you for your time today. And on to the next one.
Any other questions, or?
You guys have any questions? All right, we're good.
Okay, perfect. Thank you.